The last item on the chart is the value driver for gearing, which tells us how much debt amplified equity gains and losses. The debt ratio is the net debt divided by the total enterprise valuation, and the average is just the sum of the value at entry and exit divided by 2. It also happens to always be equal to 100% minus the average holding period equity ratio. Now, compared to what we'll see in the academic and industry models, this gearing formula is extremely simple. And it lets us calculate what the gearing would have been if the company had a different capital structure. Let's say that a typical public company in the sector has an average debt ratio of 20% instead of the higher values that we find in private equity deals. We can define this value as the sector debt ratio, or SDR, and then define the excess debt ratio, or XDR, as the difference between the sector debt ratio and the company's average debt ratio as follows. This lets us split up gearing into two new value drivers. Sector gearing is what would have occurred if the company had a capital structure similar to the typical sector peer, and excess gearing tells us how much extra gearing occurred because of those different leverage levels.